Hey everybody, hope everyone is doing well and had a good day. In this video, I'm going to review the Emini 5-minute chart for Wednesday, July 23rd, 2025. First, want to blow up the daily chart so we can see the context going into the day. Here's the information we had going into the day. The market is in a strong bull trend. We had a wedge bull flag pull back to the EMA, high 1, high 2, high 3, strong signal bar near the EMA, and a strong entry bar with a couple more bars of follow through. 4-bar bull micro channel. The odds are there were buyers below, and the bulls will get a second leg up before there's a major reversal. And by major reversal, I mean before we get back down here. Now you can see what happened yesterday. We fell below the prior 2 bars. We didn't quite get to the gap, the breakout gap created by this bar, but we found support and reversed up. There's also a 50% pullback, maybe here. It's about the same price. Expectation going into the day, probably have to go. Well, the first thing is that the high of yesterday, the high of any prior day or any prior bar, is expected to be resistance. That's the sell zone of the bar. The low of any bar expected to be support. That's the buy zone of the bar. And that's generally speaking, when you have the high of the prior day, you expect sellers above. But if we break out above the high of the prior day, resistance can become support. And I thought the bulls would get a second leg and test the all-time high, the high of this 4-bar micro channel. I wasn't sure what would happen when we get there, except that I was expecting profit taking from the bulls. That's kind of like the minimum target for the bulls: breakout, pullback, minimum second leg. And I figure the market will probably enter breakout mode at that point, and we'll see who gains control after that. But from here, expectation was breakout, pullback, bulls get a second leg, and we find resistance above Monday's high. Gap up. Let's see what the Globex session looks like. We'll look at the Globex 15-minute chart. Here's the information. Here's yesterday's close, just about right here. Spike in channel, bull trend. Open gap here, open gap here, open gap here, another open gap. So pretty strong bull trend. Bears hardly getting any bars, even touching the moving average, maybe 1 or 2 closes below. Strong bull trend. You expect the channel to evolve into a trading range, but once it's a trading range and breakout mode again, you expect the breakout direction to be in the direction of the trend that preceded the trading range. So, strong bull trend. We may evolve into a trading range, but ultimately, it's probably a trading range or a bull trend day unless we get a strong trend line break and a retest and then a strong reversal for the bears. Micro channel for the bears, 1 through 7. Strong enough momentum, probably needs a second leg down, which means the first reversal up should be minor, which means bar 7 is a low probability buy. Small risk, big reward. If you take the buy above 7, you stand to gain maybe 3 times your risk. When I say 3R or 5R, I'm saying 3 times risk or 5 times risk. R just represents units of risk. So the micro channel down should get a second leg down most of the time, but it's 3 pushes down: 1, pause, 2, pause, 3. micro double bottom, stalling at the high of yesterday and the moving average. So it makes me wonder if the market is in a bull trend or in a bullish regime. The bear micro channel is completely above the moving average, which means it might be controlled by the bulls. How can it be controlled by the bulls? Because when price gets too far from the moving average, the bulls take profits and they don't look to buy again until there's a couple of legs sideways to down and maybe a test of the EMA. We rally again, we get too far from the moving average, we have a couple of legs sideways to down. So this might just be a buy climax above a bull channel. Bulls don't want to buy this far above the average, so they look to buy lower, and that creates a sell vacuum testing support. But once we get to support, you never know how many dollars are waiting to buy at support. Reversal and follow through, strong enough for a second leg, probably 70% chance there's some sort of second leg. It's also a bad low 1 below bar 8 because of the sell-off. Stalling at the EMA in the bull regime makes me wonder, is this a sell vacuum testing support? Selling at the low of a sell vacuum, really not ideal. The bears might sell above bar 6, but if you sold above 6, you're disappointed with your entry bar, and the reversal and follow through needs a second piece, which means there are probably buyers below bar 8. So the low 1 triggers and quickly fails. We have a second reversal up on bar 10. Probably sellers here, but instead broke out above on 12. Small surprise, but 2 legs up. Also a 50% pullback. So probably sellers here. Bulls taking profits on scalps, bears looking to sell for a second leg down. So not ideal to be buying here, but strong enough rally. There's probably buyers below 12 and 11, and the bulls will probably get at least one more leg up. 13 a low 2, but a big bear bar 13, just like bar 9, just above the EMA. If the bears don't get follow through, if you're selling 13, you're forced to sell a pretty big bar just above the EMA. Your potential reward, if you're going for a new low, is less than 1R. So it's really hard to justify taking the sell below 13. Bad follow through 14 for the bears, and the bulls maybe getting their second leg up, but enough big up, big down, big confusion to generate hesitation, which happened here on 15-16. The market went sideways. We're in breakout mode. Bulls need a second leg. Bears need a second leg. And 17 was a give up bar by the bears. Probably will get to the 13 high and find sellers, and we did. So 3 legs up against the bear breakout. Bears want a second leg down. But the more bars that get added to the pullback, the more the probability gets reduced for the bear breakout and increases for the bull breakout. It's kind of like yesterday. Bear breakout, you expect a second leg down, but we get an endless pullback that grows to 20 bars. Bears exit at break even. Let's say you sold below 6, sold more below, say, 35. There's your break even price. And it could be a similar situation here where the bear flag goes on for too many bars and the bears, looking for a second leg, eventually give up. Another bear bar, but just above the EMA, just like 9 and 13. Every time we get near the EMA, the market bounces, as it did again here. Low 4, below bar 25. Small risk, big reward. You must have low probability. So there's a stop order sell below 25, but if you're taking that trade, you know you're going to lose it most of the time. But it's a reasonable swing trade. 25, stop above 25. You make maybe 3R if the market gets down to the bar 7 low. You only have to win that trade 40% of the time to make money if you're making 3 times your risk. Weak follow through on the sell. The bear bar 26, it's a trading range bar. 27, an inside bar. There's probably sellers above. It is a bull channel. You expect sellers at the channel line, sellers above, but we keep finding support below at the trend line. And this bear flag has grown to about 20 bars. So breakout probability, directional probability, might be closer to 50-50 now, rather than favoring a second leg down for the bears. And we got a big give up bar on 29. 29, bull breakout of a bear flag. Remember, a bull channel is a bear flag. You expect the bear breakout 75% of the time. This might be a nuance because the bear breakout and the bear flag are all completely above the EMA. This would be different if this was a bear trend and maybe the low 4 was testing the moving average rather than holding above it. But anyway, you can call it a surprise because it's a breakout of a bear flag, a bull channel. Surprises usually get second legs, and this breakout is big and got followed through. You can reset the leg count and expect a second leg up. But the sell-off on the open and all of this two-sided trading here, to me, reduces the probability that today is a trend day. And if that's the case, if today is more of a channel or trading range day, then we might be at the top of the channel. Here's a channel line from the high of bar 1 to the high of bar 30, and a parallel seems to work well for a trend line. Makes me wonder if the market will pull back more deeply, like the 50% pullback, maybe the low of bar 30, implied pullback, start of the channel. To me, bulls don't want to buy this far above the EMA. When we get far above, we have to revert back to the mean or the moving average. We get far above, we have to go back down. We get far above, to me, I think we have to go back down. But the market's always in long. After 33, we might be temporarily always in short. 33 might have been enough to flip the market to always in short because 33 needs a second leg down. So bulls who are buying can probably exit, maybe if there's a test of the low of 32 or in the sell zone of 33. Pause 34. Probably sell the close. It's a bad high one. After a 3-bar bear micro channel, sellers above, second leg down likely. Sell the close worked. We get another push down, but now it's a 4-bar micro channel. Probably needs another leg down. Another pause. So 1, pause, 2, pause, 3. 3 pushes down, but we're testing the moving average. We're testing maybe the 50% pullback. And the rally is likely to get a second leg, and the bears just had 3 pushes down to support. 2-bar reversal, 38, reasonable stop order buy, looking for a second leg up. You know it's low probability because the risk is small, the reward is 2 or 3R, which means you must have low probability. There's no such thing as a perfect trade because there are institutions buying and selling on every tick of every bar, and no institution, no one is going to take the opposite side of a perfect trade. If a trade is perfectly good for you, it's perfectly bad for the other trader. You cannot have small risk, a big reward, and a high probability of making money. You have to have a trade-off. You either get good risk reward or you get high probability, but you do not get both. So if you're buying above 38, you know your risk is small. You know you're looking for a new high of the day, so your reward is several times your risk. That means you must have low probability. No trader will take the other side of that trade unless they have high probability because their risk is big, their reward is small. They can only justify taking that trade mathematically if they have high probability, which means you have low probability. So 38, reasonable stop order buy. It's in the always in direction, and it's a good signal bar, 2-bar reversal, and a good entry bar, 39, similar to, reminds me of 7 and 8, where you have this sell-off, but it's down to support. Now you have a bad low 1 below bar 8. This sell-off down to support after a breakout. Remember, a gap is a breakout. So these are actually really similar. You have a gap up, a pullback, a bad low one with buyers below, gap up, a breakout is a gap, pullback to support, low one short below 39, probably buyers below 39. Bulls get a small second leg, which damages this bear trend line even more. So bear trend, minor bear trend, trend line break, expect a retest of the lows and expect buyers down here. 46, double bottom, bull flag, near the bull trend line. Trend line isn't perfect. Different computers draw it different ways. Maybe it's like this, and the market is testing the trend line with a double bottom after a strong bull breakout. So another reasonable stop order buy above 46. Signal bar not as strong as 38, but context is good. The bears have a breakout and a second leg sideways, not quite to a new low, but that is at least a completed structure. Breakout, complex pullback, attempt at a second leg, and now it's a double bottom bull flag. So if we break out above, see, at this point, bears selling for any reason probably exit above 47, and bulls can buy the close 47, or you can wait for follow through, buy the close 48. But it's always in long. You have a 3-bar micro channel, double bottom, bull flag. The market's probably going higher. You can exit below a sell setup and just exit below a bear bar closing near its low, but you never get one. Buy climax 51. You can take profits on the close of 51, but the profit target is so close, you're probably going to get there. And I think it's okay to take profits on the close of 51, or just let your limit order at the high of the day for the profit target to get hit. 52, expected hesitation. Now it's 3 pushes up. We can redraw the channel line like this. 1, 2, 3. We're at the top of a bull channel, so we're at resistance. We're in the sell zone of a bull channel. And this is the area where bears look to sell and bulls also look to sell. Bulls are taking profits. We're far from the EMA again. And every time we get far above the EMA, the market pulls back before we find buyers at the EMA again. We get far above, pull back to it, get far above, might have to pull back to it again, which we did in just 1 bar on 53. We tested the breakout point, 46 high, the moving average, the bull trend line. So there were buyers here again. And the bulls again getting a breakout to a new high. For me, this is a no trade, just because it's a late leg. 1, 2, 3 legs up. Breaking above a channel line, the probability isn't strong enough for me. Usually breakouts of channel lines reverse within 5 bars and test the trend line. So I would rather not trade this breakout, or at least enter on a deep pullback, maybe here. If you're long for any reason, you can exit below a bear bar closing near its low, like 58 or like 60. Starting to hesitate, we're going sideways above the EMA, probably going to go sideways to down and test it before we find buyers again. Five-bar bear micro channel. It probably needs a second leg. 1, pull back, 2, pull back, maybe 3 legs down. Wedge, bull flag, testing support. Too late in the day for me to trade, but in theory, 76 is an okay stop order buy. It's a high 3 in a bull trend, and the signal bar is strong. And it got good follow through. 78, probably a sell to close bar to take profits, not to go short. But if you're long for any reason, Again, assuming it's not bar 78. When you have a bear breakout like this and it fails, you'll sometimes get a measure move up. And that's what we got here on 78. So I think it's reasonable if you're long to take profits during or on the close of 78. And to me, 79.80 is profit taking by the bulls. And then this breakout got its own second leg up. So that's going to do it for today's review. Thanks everybody for watching and listening, and I hope everyone has a good night.